The journey of an entrepreneur actually starts off with one thing, and that is, this is mine, this is my thing. I want to build the company. The whole point of the first thought is, I will build this thing. And the I is quite important in this, because as you start off, this is what you are trying to do. You're trying to make yourself the center of the universe and trying to solve a problem for the world. And a tremendous amount of blood and sweat goes into building even something very small. And that tremendous effort translates into a company that an entrepreneur calls his or her own. And more often than not, the entrepreneur actually loves the company that he or she has built more than himself, and sometimes even his family. So there's a lot of possessiveness that is there when you build and you start off on your own. And then when you look at starting or growing the company, one of the few things that you do is you find ways to take on capital. First of all, it is your own money or your dad's money or family money. Sometimes it is debt, and usually it is from a known person. You go to your parents, you go to your in-laws, you go to your friends, and you know that they're not going to be a pain. So that is the first easy um, call. But then at some point, the capital that you generate from your friends and the capital that you might generate from profit just becomes insufficient to fuel the growth ambitions. It just means that you need to take on more. And we have personally gone through this process, and the realization could be even a few months after you start the organization, the entrepreneurship journey, or it could be a few years. That doesn't matter. What matters is that there will be a point sometime that you will start thinking beyond your own self, that you want to grow beyond what you are capable of. And for that, more often than not, one needs capital to grow. Um, and it also happens in many mature businesses that after running it for some time, you are short of capital, you're short of what you are making through your regular profits. And that is when I think the big churn in the stomach happens. That is where that is where the big question comes. And the question is, should I dilute a significant stake in the company to take it forward? And this is not a very trivial question. I personally feel that this is not a very trivial question. People struggle with this question all the time. And I personally struggled with this question. Me and my partner struggled with this question as to how should we go about this? Should we just continue with whatever we have, or should we increase our ambition and go to the outside world? On all kinds of questions cross one's mind. Um, the biggest concern, obviously, is that will I lose control of what I have built so passionately? That is the biggest concern. Will I have strength to follow through with my investors, negotiate with them, and continuously keep them happy? Because one of the things that we all becomes a quarterly game. Every quarter you have to report your profits, you have to show increases, and those kinds of pressures come into play, which are not into play when you're doing this on your own and you do not have a significant amount of capital invested from the outside. Another question that comes, and it's a very important one: should I go the private equity route, or should I raise capital via an IPO? Um, and then will I become an employee of sorts with no decision-making powers or very little decision-making powers, especially from the strategy point of view? When you have people sitting on your board, um, would you have enough say in the running of the organization? And then one more thing, all my profits will be shared with people who haven't done anything to bring the company to this stage. So far it is your own organization, but now henceforth it will be shared, and whatever you have built over the past years, will it be diluted, and will you have to share the spoils, whether it is profit or the reputation, etc., etc., with a bunch of people that you probably don't even know? And all of these thoughts are quite natural, and I'm sure that many of us, a vast majority of us, Diluting stake in a company that you have started is almost like giving away a limb. It is that bad. At least for me, it was that bad. We had sleepless nights when we had come to this conclusion that we had to give away some part of our organization for the larger picture. And I'll try and share what I and my partners went through. So as an entrepreneur, when you build an organization, you have a very strong affinity towards the company. And in our case, it was more than 15 years since we started this company when we started to look out. And I was personally very, very apprehensive because so far, even though we were growing well, it was just me and two of my very close childhood friends. We had a very, very strong bonding, very strong inner circle. We had been together since college or school, and we even had our own lingo of conversation. We knew how to speak with each other. We knew how to resolve differences. We completed each other's sentences to that extent. We partied together, we vacationed together, we had a good time together, we had bad times together. So bringing in a fourth person to the table, we never wanted that. It was a very, very, very tough choice for us. We never wanted to get an external party talking to us, dictating us terms. And we had no clue what we were getting into at that time. We had all kinds of apprehensions, we had all kinds of misgivings. I've already talked about those questions that came through our minds. And it was a tough few months, and especially since we had been running this organization for about 15 years before we actually went out to get outside capital. I think what helps here is, what is your large picture objective? Any company can run either in a small way, or it can run in a expanded way. You can have a very small 5% team, or you can have a 50,000-person team. Um, Scale is a choice. What kind of scale you want to take your company to, it is a choice. It is not something that is forced upon you. You can make it a lifestyle company, you can make it a medium-sized company, you can have an ambition to make it a really large organization. But having a clarity of objective of the venture, I think that would help in making the correct decisions. And the objective wasn't very clear to us on day one when we started the organization. I don't think any company starts with the objective of going public, taking the company IPO, bringing in outside investors. That is not the day one objective. The day one objective probably would be a little different. I want to solve a problem. I'm fed up with my job. I want to earn more money. Um, I just want to be independent, etc., etc. There could be very different objectives. Um, Somewhere down the line, on the InfoBeans side, uh, personally, I had developed this objective over a period of time, not, as I said, not on day one. That for me, the objective of the company of InfoBeans was to make it the best place to work at for all its team members and continuously grow the team. So if we were to make it a really good place to work at, provide really good employment for one person, can we do it for 10? Can we do it for 100, 200, and so on? And and I think anything that we do, including making a profit, is a result of following this objective. Making a profit is not the objective. Making a company very large in terms of market cap, that is not the primary objective. The primary objective for us remains to make this the best place to work at for one person or a million. That piece does not matter, but we always wanted to grow the organization. So to continuously fulfill that objective, we felt that the kind of pace that we were growing at, we would be soon, getting bored of it, and we wanted to get outside capital to grow. That was the decision point. Um, for the longest time, more than 15 years, as I've been saying, we kept saying no to outside capital. We said no to debt. Debt doesn't even make sense in our kind of a services organization. We said no to private equity. We said no to acquisitions. We got multiple offers for private equity, for acquisitions from foreign investors, from local investors, from people down the street. Just said, we know you and we want to put money in your organization and so on. There were acquisition offers as well. But um, all the time, we ended up thinking that will we end up with someone who's not going to be as much like us as we are. And we realized that money has color. One needs to choose, and the choice will not come through an Excel sheet. One needs to really pick and choose the kind of investors, partners, even financial institutions that you want to take on board. And it will, as I said, it will not come through a calculation. It will come through the gut. It will come through face-to-face interaction by knowing people better. And the highest bidder will not necessarily take the stake. And we found that we didn't make a mistake, but we experienced it, that when we went to talk to a few people, some people had a very and they're not wrong, they had a very quarterly sort of an objective that, oh, next quarter we want this much profit, after that we want that much profit. And what if you do not make you do not have make those profits and make those goals, what is going to happen, and so on and so forth. And those were the people that we actually said no to proactively, that this company is not for you, because we had a much more longer term vision than going quarter by quarter. um, so the highest bidder will not necessarily take all the spoils. And I say this with a lot of conviction because I've been through this. And this is one really big mistake that we could make as entrepreneurs, that we just give away all our equity, or all our part of our equity, to people who just pay us a lot of money. And these people could actually be some of the biggest pains that you would have to endure for the rest of the professional life of that organization. Another thing is that there's no good time, especially the first time round, to dilute the equity. There could be a good timing, a very short bit of timing, that the markets are good or bad. But if you really have a very long-term vision, then you cannot really time the market forever. Like right now is a good time, but are you prepared enough? And then 3 or 6 months down the line, and the markets might not be performing as well, you might think, oh, you've lost the bus. But no, that is not the case. And I'll come to that a little bit later as well. But just waiting a little bit can be okay, but if you wait endlessly to time the market, to catch a falling knife, as they say, I think that could be actually very detrimental to your ambitions and the business. So how do you go about this? Again, few pointers. We need to be very specific in terms of what we desire from a fundraise when you go to the capital markets. You need capital, of course. You need very good investors who can speak your language, investors who can guide you properly without a very myopic view of the future, and a good board. So again, you have to define what you need, and then be very specific in what you're willing to give up: control, equity, both, nothing. What is it that you want to give up in return? And trust me, this is going to be the single most important decision in taking your venture to scale when you go outside to raise capital. And I'll talk a little bit about going public, because that is what we did. We did not end up taking private equity. We chose the IPO route, even though we still are a very, very small organization compared to the others that you might hear of. But people have a very common, they have many, they have a very common perception about going public. First of all is that there's a huge cost and hassle of compliance. Um, Yes, there is a cost, and there is, I would say, not a hassle, but there is a little bit of a challenge in terms of compliance, especially when you're starting off a new venture. You're not totally compliant. You cannot you do not work within the confines of the Big Four auditing rules, and you end up spending a lot of time initially to be compliant, to try and see how you can improve your processes, improve your governance. But if you look at the larger picture, it is not that much. It is It is but a drop in the ocean. Again, in a very long term view, the exposure and the high of taking a company public will far outweigh any costs. And in today's day and age, you don't really have to be a monster, a really large, gigantic organization to go public. When we went public, our market cap was less than 100 crores. And our revenue, I think, was about 40, 50 crores, something like that. And this was just 4 years back. Not even 4 years back, yeah, 3.5 years back. So you don't have to be extraordinarily large. You don't have to worry too much about the cost and the hassle of compliance. It is not that much. It might appear to be large, but it is not really that much. Plus, it will force you to improve the corporate governance of the company, and this is really important. Again, if you're looking from a very long-term perspective, if you want to get professional management on board, if you want to create systems and processes, good corporate governance is something that is imperative. And trust me, good corporate governance actually sells in the market. People like good companies. People like companies that are run by good people, that have good processes, have a lot of transparency, and you can actually get a premium on in terms of your reputation, in terms of your valuation, that you follow some of these really good governance practices. And if you don't, then it actually can come and bite you at the back sometime later, because if you want to get acquired, if you want to sell your organization, and if your books are not in order, compliances are not in order, and we actually went through such a situation with another company that we're trying to acquire. We had to go back on our offer because they were just not managed well enough. So taking a company public, taking a company IPO, going for an IPO is definitely, in my opinion, worth the cost and hassle. And sometimes it is better than going the PE route. Now, I'm not trying here to, sort of making a case of one against the other. It is just what we thought at that time was correct for us. Not in every case would an IPO be better than a PE. Not in every case. Um, Um, my personal experience, and again, this is after a lot of anxiety, this is a lot of churn in the stomach. My personal experience with investors is that the vast majority who will put money into a company will be good people who want nothing more than a decent return for the investment. Most professional investors know that they shouldn't be meddling into the day-to-day affairs, and they should have at least a couple of years of runway rather than just going quarter to quarter. Most of them. There will be some people who will crib about anything and everything, but that is okay, and you'll have to take them into your stride. There will be people who will be questioning every little penny that you spend, and I can quote an example. There was a huge hue and cry that when we had gone IPO, we had come out with a newspaper ad in the Economic Times for about, I don't even know. I think it was 4 or 5 lakh rupees or something. And at our size, it was peanuts. But we actually had to face a Twitter storm on this. People questioned us. Why have you come out with a newspaper ad after going on the day of going public? And that too in ET, and it was a huge hue and cry, and we had to actually answer. But then that is okay. I guess people get to know you better. You do the right kind of communication. You talk to them. You assuage their fears. You give your reasoning. Communication with investors actually is very, very, very important. And so these things will happen. These things will always happen. You'll have a bunch of people who will try and question you, and you'll have to just handle them with maturity. The biggest thing is, especially going IPO and definitely in a PE situation, is that you need to have a good anchor investor, someone who understands your business and allows you freedom to operate on a day-to-day basis. In our case, we have been very fortunate enough to have a few such anchor investors who have still not sold their stake even after 3.5, 4 years, and they have already made 9x, 10x returns. And these were the people who have been with us in thick and thin, who have been with us through COVID last year when there was a huge amount of uncertainty. They refused to sell. And then there were other kind of anchor investors that we had, very small number, who after 1 or 2 years said that the stock is not working out for them and they want to sell, which was absolutely okay. They made about 1.5x over a period of 2 years, but then all hell broke loose in the stock market, and they're ruining their decision of not sticking around long enough. So there will be all kinds of people, but yeah, one anchor investor who understands you, understands your business, understands that everything is not going to happen overnight, will help your cause hugely. Um, then the structure of the deal will also make a difference. How much stake do you dilute? How much you give to a single investor? How dependent is your company on a single investor, and vice versa? How much, and again, how much dependent is that single investor on your company to run his or her fund? I think that is also very important. If that person is too much dependent on your investment, on the investment in your company, then that is also going to be a problem. So all of these things, we learned the hard way. Some of these things happened, and we wrote them down that this is how it should happen. And some of these things, you learn as you move forward. So again, it is something that you can negotiate on. It is not something that is a given. One thing that I've learned in the entire process is nothing is a given. There is no such thing as a rule in investment. Yes, there will be a lot of market ki dhara bolte hain usko, a lot of things that are unwritten, a lot of things that are taken for granted, but you can go ahead and negotiate many of these things. Nothing, this is again something that the entrepreneurs come to me and ask that, oh, is this going to happen this way only? Is there any other way to do it? And nothing is going to happen that way. Except for government compliances, government rules, there's nothing else that you need to really stick to as a rule. Then there's a really big question around the valuation. Whatever the valuation it would be, it will, as an entrepreneur, it will always appear to be low, always. But again, very quickly on the valuation side, and again, this is again a very anxious thing, and you'll keep on second guessing yourself even after you go IPO, even after you give out your money to a PE. You'll keep on second guessing yourself, and you'll ask, have I sold it at a lower price? Could I have sold it at a higher price? But on the valuation side, it is important that people make money. And again, long-term thinking, that if your investors make money today, they will be happy to give you more money 2 or 3 or 4 years down the line. What we have learned is that this process does not end. It actually makes you even more bold. It makes you bolder that, oh, today I've raised 50 crores, tomorrow I can raise 500 crores. To do that, you again need a reputation in the market. It is not that somebody will just stop by and give you that bag of money. So unless you leave money on the table proactively, knowingly, even with a heavy heart, you will not get good investors, and you will not create a reputation for creating wealth for others. A big part of going IPO, a big part of raising outside capital is creating wealth for others, not for yourself, for others. Remember this piece always. You're not only creating wealth for yourself, it is about creating wealth for others. And for yourself, at least in our case, we diluted our stake, we did not sell our stake. And people always come back to me and say, oh, you've become rich and everything, but it's only paper money. The real money is in the hands of people who can actually trade the stock. People like us, the promoters, we cannot trade the stock. So whether it is 100 rupees or 500 rupees, it does not really matter much. The house that you live in, even if it appreciates 10x over 3 years, it is still the house that you live in. You cannot really sell it. You cannot sell, 5 square foot of land and say, okay, tomorrow I'm going to have a fun time with this kind of money. So, so you have to leave money on the table. Investors are looking to get returns in multiples, and not as a percentage of not as the slightly better than the bank interest. That is not their business. They want to create 2x, 3x, 4x multiples in a very short 2 or 3 year period of time. And that is why it is all the more important that you leave money on the table. And we as entrepreneurs value worry a lot about valuation, I think it is a fair thing that that worry is very natural. At the same time, it should not be a stumbling block. As I said, if you create money and wealth for others, your wealth itself will also increase over a period of time. And in any case, most entrepreneurs are not in it to create wealth for themselves. They are there to solve larger business problems, larger people problems, larger society problems, rather than just create a whole bunch of wealth for themselves. In the end, everything is worth it when people come up to you and say that we have used your stock to make money, to we've sold it at a profit to buy a house or put it for a daughter's wedding. And it has happened with me, actually. And it has happened with actually a very large about 10-20% of his stock, and we were having a chat, and that person actually said, oh, you know what, I actually sold it to buy a piece of land adjacent to his existing house so that he could increase his size of the house. There are people who have come up to me and said, we'll keep this stock for the next 5-10 years and put it for my daughter's wedding. And that is, I think, where we should derive the maximum satisfaction. That is where at least I feel tremendous pride, and also a sense of responsibility. Uh, in the end, I feel raising funds on a large scale or taking a company public is a unique experience. And that experience, that journey, every entrepreneur has to or should go through. Um, it is very satisfying, very fulfilling. It really helps you in terms of your reputation in the market, which I personally value a lot. And I think all of us should at least look at it closely. We've talked about some of the misgivings, some of the misunderstandings, some of the realities of what raising funds is, some of the anxieties that one goes through. But in the end, I think it is all worth it. Um, just a couple of more things, very interesting. People will always come up to me and ask me about the stock price, especially my relatives and friends. They'll always say, oh, Siddharth, give us a tip. And again, my thing to them is, if you believe in me, if you are my relative, if you have the guts to come and ask me for a tip, then just go ahead and invest. Why are you, why are you waiting for the right time? There is no right time. Um, our investors, initial investors, have reaped tremendous returns. Very proud of that. And the last one, and very important, especially if you are alone, if you do not have founder with you. Two of my very close friends working with me. There's a lot of stress and anxiety throughout this process, and one needs to be very calm, cool, and collected. So try and manage that stress. Not saying that, I mean, I get very stressed sometimes, and in this entire process, all of us got very stressed up. We used to talk with each other, crack jokes, etc., etc. But I can imagine that people who do not have partners, co-founders, they can get really worked up, and a lot of unknowns can come up. But um, having said that, managing that stress is important, and the end result, I think, will be really good, hopefully. That is all that I had to speak about. um, I'd be happy to answer any questions that anybody might have. Professor, back to you.
Yeah, I think there is something in the chat, Siddharth. Maybe we can start with that and then.
Sure. Okay, so what is your ambition with respect to InfoBeans? Do you want to make it a large company? See, the ambition, I've spoken about it. The ambition is to make it the best place to work at, whether large or small. Yes, why not large if we can do it? This is, an infinite goal. It is not going to be, we don't claim to be the best place to work at. And I do not think that this is going to be the best place to work at for the next 50, 100 years. It is a continuous day-to-day process. And if people are happy working at InfoBeans, I think that would be a really good achievement. So this is my ambition with respect to InfoBeans. Whether large or small, I think that is not in my hands. Um, okay, there's a follow-up question. Where do you see, by Rahul, where do you see InfoBeans after 10, 20 years? Same answer, same answer. Again, if we are able to create a company that is good for my team, I think I would be happy. There's no way that I can predict whether it will be $1 billion company, $100 billion company. I really don't know, and I don't want to go that route. We want to grow, that is for sure, but we want to grow in the right manner, and we want to grow with our team in the center of the universe for us. We are not a client-centric organization. We are not a profit-centric organization. We are not an investor-centric organization. For me personally, it is my team that comes absolutely first, above and beyond anybody else. So I hope that answers that question. Okay, Siddharth Raghuraman, I've been a proud investor for a while now, since InfoBeans is the only listed company by an IIM Indore alum and is one of the fastest growing companies in the space. Oh, thank you. Thank you so much for the compliment, and thank you for being an investor. Thank you so much, Siddharth. Rishi, sorry to sound like one of your relatives, but is the current stock price 400 to 500 band a new normal for the company, or do you think these prices are abnormal? I cannot answer that. I'm so sorry. All I can say is that we are trying our best to make this a really good company. Mrityunjay, thank you, Siddharth sir, for such an insightful session. Thank you, Ganesh sir, for organizing this talk. Looking forward for many more such sessions. Thank you so much, Mrityunjay, for your kind words.
Siddharth, a question from my side.
Sure, sir.
See, this from what I saw is that you're also wearing the other hat of investing in new age companies. Is that correct?
Yes.
So, what is it that you look for when you want to invest in these new age companies?
Yeah. The only thing that we look for, and I'm saying this with all honesty, is a good team, because everything else will fall into place. If there's a good team, people who can change with the times, people who we know, who we have worked with. There was a case where we invested in a company about 6-7 years ago. They exited, and we got a very handsome return. And their second organization, the second company that they founded, we actually put in money over like half an hour. We knew, actually we proactively reached out to them and said, you know what, are you looking for outside funds for this new venture of yours? They said yes. We said, okay, we'll put in money. They said, do you want to do due diligence? We said no. And within half an hour we sent them out a check. So that is the single most important thing. There's nothing else. There is one small thing, that we don't want to invest in businesses that we totally do not understand or have some shades of gray. And I say some shades of gray is something like real estate, for example. We don't really want to get into that sort of a game. But that is our personal thing. I think from overarching point of view, I think it all boils down to the team. Even if they are selling vegetables, and if they can do it in a very good manner, then we'd be very happy to invest.
So this one you do from the company side, or you do it on your personal capacity?
It is on the personal capacity. It is not on the COVID side.
Okay. The other thing that I wanted to ask you was that what do you think about the current valuation of some of the new age companies like Zomatos and the Paytms of the world? The kind of fees that is being commanded on listing is so huge. Of course, same question could be asked of Amazon or Yahoo or any of these companies when they listed. So
I think, and the same can be asked for InfoBeans also. I think it's a demand and supply gap. People have a lot of money and they just
there is a difference. A company like Zomato, what is their asset base? What is their, whether it's human capital, whatever capital you want to do, what is their asset base?
Personally, I know a bit about Zomato. I know Sanjeev Deepchandani, Info Edge. I know a little bit about them. I think their name to fame is one thing is that they have almost become like a monopoly. Almost, it's a duopoly. You have Zomato and Swiggy. There's nobody else. So that is there. Plus, they have tremendous experience in growing this business, and what you're seeing today is investment in the future and not in what is there today. So people are actually trying to gaze at a crystal ball and trying to see what will happen 4 or 5 years down the line. And as I said, also, my personal opinion also is that this is all about demand and supply. There's huge capital running around right now. People really want to invest. China is not doing that great. all these Chinese companies are, nobody's investing in Chinese companies right now. So the next big growth area is India. And in India, you have these handful of startups, unicorns, that at least provide some sense of scale and stability. Um, I have a few more questions. I think they are there. And then, sir, let me know whenever we run out of time. Um, what is your, Siddharth Raghuraman, what is your view on acquisitions? How easy, difficult is it to integrate the business, and what are the challenges with respect to people management? The view on acquisitions has actually changed. Earlier, we were very dead against acquisitions. When I say earlier, I mean before we went IPO. We looked at it very, skeptically. But after IPO, and the whole reason for the IPO was to do an acquisition. I think it's a it's a double-edged sword, and it's a very risky affair. But um, what we have learned is one should not just acquire for the heck of acquiring. One again needs to look at the people. We have done 2 acquisitions till date. Both of them are performing extremely well. And I think the credit goes to the people. It does not go to the business itself. I think businesses can be ruined in a matter of weeks and months if the people are not right. But the management team on the other side, if they think the same way as you think, I think that would increase the chances of success. It is very difficult to integrate. There are a lot of ego issues that come into play on both sides, not necessarily the acquiry company, but on both sides. People issues always come into the play. People are fearful, what is going to be my role now? Again, on both sides, not only on the acquiry company, on the acquirer as well. If you, especially in the cases where you have some kind of an overlap. So there are definite challenges. It's not an easy thing to do, but it is something that should be done if you have the appetite and if you have the cash flow to manage it. Um, how do you go about choosing the fourth member you were talking about? How to choose the right partners or co-founders in your opinion? So we don't have a fourth member. It is still the 3 of us, and that is one reason why we went IPO. We did not want to get a fourth member on the table. In a PE scenario, you would probably get a fourth member on the table because bulk of your equity is going to one single entity. So they would want to have a say. And that was one very big reason why we did not want to go the PE route. So yeah, we do not have a fourth member, and that is something that is very close to our hearts, the 3 of us. As long as we can resist it, we'll try not to have a fourth member. And again, this goes to your ambition. There's no reason, I mean, there's no good or bad in having a fourth member. It is just the way we want to run InfoBeans at this point. Tomorrow it might change. What are the parameters used to judge a team? I think they should be people oriented. Judging a team, you cannot judge people by 1 or 2 meetings. So what we generally end up doing, especially in our 2 acquisitions, we started working with them before we even acquired them. In both cases, we did 1 or 2 projects with them. We had very good interactions with them, very deep interactions with them. And that is how we came across to the conclusion that, these are like-minded people, not necessarily the right or wrong people. These are the like-minded people. So this is one of the methods that we have used, and so far it has worked. Your company's always, Rishi, your company's always beaten the industry average in year-on-year profit revenue growth. Do you expect this to continue, or do you see the profits plateau as the company continues to grow? I do not think I can answer that, Rishi. That will be a forward-looking statement. But as I said, we will try very hard to always perform our best.